Hi, everyone, this is the Encyclopedia Channel. Since stock trading was invented, countless people have achieved financial freedom through stock investment, and quite a few investors still hope to put their existing wealth and assets into the bank. The funds in the stock market are transferred to the stock market to buy stocks again to achieve wealth appreciation and asset growth. So, why choose to invest in stocks? How do novices invest in stocks? Stock investment is an investment method that can obtain long-term returns. When a company performs well and grows steadily, its stock price also rises, bringing returns to investors. Moreover, investors can obtain higher returns by holding high-quality stocks for a long time. At the same time, as time goes by, investors' investment risks will gradually decrease. And stock investment can achieve asset diversification. If an investor only holds stocks in a certain industry or company, once the industry or company encounters unfavorable factors, the investor's investment will be seriously affected. However, if investors diversify their funds into stocks of different industries and companies, they can reduce investment risks and achieve asset diversification. In addition, the stock market is highly liquid. The stock market is an open and transparent market where investors can buy and sell stocks at any time. Compared with other investment varieties, the stock market has higher liquidity, and investors can cash out at any time to meet their personal capital needs. Investing in stocks can also help investors withstand the effects of inflation. Inflation will lead to currency depreciation, and the currency assets held by investors will also be depreciated accordingly. While the stock market can provide inflation protection because the earnings of good companies grow over time, the stock market can also provide dividend yield. Although it is said that stock investment is an investment method that can achieve wealth appreciation and asset growth. However, investors, especially those who have never understood the stock market, should learn and pay attention to the basic knowledge and investment skills of the stock market before investing in stocks, formulate investment plans, and diversify their investments to reduce investment risk. At the same time, it is also very important to maintain a rational investment mentality, not to be swayed by short-term fluctuations, to strengthen confidence in holding shares and wait patiently. 1. Learning the basic knowledge of stocks. Learning the basic knowledge of stocks is the first step in stock investment. You can learn through online courses, books, or attending stock investment seminars. This helps investors understand the stock market, master the basics of investment, and increase the success rate of investment. Like types of stock. Stocks are generally divided into two types, common stock and preferred stock. Common stock is a common stock that entitles the holder to dividends from the company and voting rights at shareholder meetings. Preferred stock usually has preferential dividend rights, but not necessarily voting rights. Investment risk. There are many risks involved in investing in stocks, such as market risk, industry risk, company risk, etc. Before investing in stocks, you need to understand these risks and manage them well. Corporate financial report. A corporate financial report is a report on a company's financial condition, including the company's revenues, expenses, profits, assets, and liabilities. Investors need to learn how to interpret company financial statements in order to better understand the company's financial situation. P/E ratio. The P/E ratio is the ratio of a stock's price to its earnings per share. It's a measure of a stock's value, and investors need to understand how the P/E ratio is calculated and used to assess the value of a stock. Stock index. A stock index is a measure of the performance of the stock market. For example, the Dow Jones Industrial Average is an index made up of the stocks of 30 U.S. companies. Investors need to understand the different stock indexes in order to better understand the performance of the stock market. Stock trading. Understanding the basics of stock trading is a must for investors. Stock trading is usually carried out through stock exchanges. Investors need to understand how to trade stocks, how to place orders, how to choose a trading platform, etc. In addition, investors need to clarify their own investment philosophy and investment goals. Is it for short-term profit or for long-term investment? Is it the pursuit of high risk and high return, or is it a prudent investment? Then to choose the right stocks, this requires investors to understand and analyze the fundamentals of a company, such as income, profits, assets, and liabilities, as well as factors such as industry and market trends, to choose stocks with potential. Although they choose stocks with potential, there are certain risks. Therefore, investors must also be able to manage risks, such as setting stop-loss points, diversifying investments, and avoiding excessive leverage. At the same time, investing in stocks requires investors to spend time and energy, which also requires investors to choose investment strategies and methods that suit them according to their time and energy. Learning the basics of stocks is not only a necessary condition for investing in stocks, but also one of the keys to successful investment. Investors should make full use of various learning resources before investing in stocks, such as stock investment websites, investment books, investment lectures, and other learning opportunities. Earnestly study the basic knowledge of these stock investments and continuously improve their investment level. In addition, investors can practice investment skills by participating in simulated stock trading. Most importantly, investors should continue to learn and keep an eye on the stock market in order to make informed investment decisions. At the same time, we must maintain a prudent and calm investment attitude and avoid blindly following trends and overconfident mentality. 2. Formulate an investment plan. Formulating an investment plan is one of the key steps in investing in stocks. Before starting to invest, it is recommended to formulate an investment plan. It can help investors invest more systematically and methodically, thereby increasing the probability of investment success. This plan can include investment goals, investment time, investment amount, etc. First of all, investors need to clarify their investment goals, such as long-term investment or short-term profit, whether to achieve financial freedom or to obtain additional income, etc. You also need to determine your investment strategy based on your own risk preference, whether to choose a stable investment or a high-risk and high-return investment. Then determine the time frame of investment, whether it is short-term investment or long-term investment, whether to hold stocks for a few months or a few years. Secondly, investors need to disperse investment funds in different stocks to reduce the risk of a single stock to the investment portfolio, so as to avoid huge losses of wealth assets. Each investor can set the stop-loss point of the stock price drop according to his own risk tolerance to control the risk. Of course, investors regularly check their investment portfolios to ensure the effectiveness of investment strategies, and adjusting the structure of investment portfolios is also a technique for reducing risks. Formulating an investment plan requires investors to fully consider their own financial situation, investment experience, and risk tolerance in order to formulate a reasonable and feasible investment strategy. In addition, investors can also seek advice from professional investment consultants to help them formulate a more scientific investment plan. 3. Research the company. When investing in stocks, researching the company is a very important step. Only with an in-depth understanding of the company can we make more accurate judgments and decisions. So, how do we research companies? First of all, we need to understand the basic situation of the company, such as the company's main business areas, the company's history, the company's organizational structure, etc. Such information can be obtained from the company's official website, annual reports, announcements, news reports, etc. Second, we need to analyze the company's financial situation. This includes understanding the company's financial statements, such as balance sheet, income statement, cash flow statement, etc., and analyzing the company's financial position, profitability, debt levels, etc. It should be noted that the financial statement is only a part of the company's financial situation, and it needs to be combined with other information for comprehensive analysis. In addition to the financial situation, we also need to understand the company's market situation. This includes understanding the company's industry competition environment, market share, consumer demand, etc., as well as the company's market positioning and competitive strategy. The understanding of the market situation can be obtained from industry reports, market research reports, news reports, and other channels. Finally, we also need to understand the company's management team and corporate governance structure. This includes understanding the company's executive team, board members, governance structure, etc., as well as the company's corporate culture, core values, etc. This information can be obtained from the company's official website, announcements, news reports, and other channels. In general, researching companies requires various information and data, and investors need to conduct in-depth analysis and research. Only by mastering this information can we make more accurate investment decisions. 4. Diversified investment. When buying stocks, don't put all your money into one stock, but diversify your investment and buy many different stocks to disperse and reduce risks. There are various risks in the stock market, such as market risk, industry risk, company risk, and so on. In order to reduce the risk and volatility of investment, investors can invest funds in different industries and stocks of different companies. In this way, even if a certain industry or a certain company fails, the risk of the entire investment portfolio will not be greatly affected. When investing in stock diversification, investors should try their best to choose stocks from different industries, different market values, different styles, and different regions to ensure a certain degree of diversity in the investment portfolio. At the same time, investors should also pay attention to controlling the proportion of a single stock to avoid excessive concentration of investment in a certain stock, which will lead to an increase in the risk of the entire investment portfolio. 5. Rational investment. In stock investment, the stock market fluctuates greatly. Don't be affected by short-term ups and downs. Keep rational investment. You should not blindly follow the trend due to factors such as emotions and media hype. You should base your investment on rational analysis and investment plans. Make a decision. First of all, you must understand your own risk tolerance, conduct sufficient research and analysis based on your own risk tolerance, understand the fundamentals, financial status, industry prospects, and other information of the invested company, and formulate an investment plan based on this information. And always keep calm when making investment decisions. Stock investment is a long-term investment. Investors should be patient and persistent. Don't buy or sell blindly or act impulsively because of short-term fluctuations, but insist on long-term holding. Considering the risk of stock investment, diversification is one of the important ways to reduce investment risk. When investing in stocks, investors should diversify their funds into multiple different stocks, thereby reducing the risk and volatility of the entire investment portfolio. Secondly, investors should be able to strictly restrain themselves and maintain discipline. They should not make wrong investment decisions due to emotions or short-term fluctuations, but should stick to their own investment plans. If the investment plan deviates, investors should make timely adjustments. 6. Long-term investment. Stock investment is long-term. It is to invest funds in the stock market and hold stocks for a long time in order to expect returns through the long-term and stable growth of the company. It is recommended not to regard money as short-term speculation, but to be patient and hold it for a long time. Compared with short-term speculation or frequent trading, long-term investment has more advantages for investors. In addition, holding stocks for a long time does not mean that there is no need for continuous supervision and attention. Do not sell blindly when the market trend is unfavorable, but keep calm and continue to pay attention to the company's performance and financial situation, as well as factors such as the macroeconomic environment. Analyze the situation and adjust your investment strategy in a timely manner. Long-term investment is a relatively stable and reliable investment strategy that can help investors achieve stable returns in the stock market. Investors need to choose high-quality stocks, diversify their investments, continue to pay attention to company performance, etc., and have enough patience and perseverance in order to obtain long-term investment returns in the stock market. Finally, it is recommended that you do your own financial planning before investing. Make sure you have enough funds for living expenses, and don't invest all your funds in the stock market. Remember the key points of knowledge? Do you have a different suggestion? Welcome to leave a message in the comment area to discuss with everyone.